Back when I worked in private equity, some of my favorite real estate investments were net lease properties. A net lease investment is a freestanding property that's typically service-oriented and occupied by a single tenant. These are things like Walgreens pharmacies, Dollar General convenience stores, Chevron gas stations, or even Taco Bell fast service restaurants. We call these net lease properties or even triple net lease properties because the lease is structured very favorably to the landlord. The lease term is typically over 10 years long. The lease also includes some automatic rent escalations each year of 1 to 2%. And finally, the tenant is typically responsible for all the property expenses, including the utilities, insurance, property taxes, even the maintenance of the property. As a result, the cash flow generated by net lease properties is typically very consistent and predictable, and there is very little managerial work required from the landlord. Despite this, these properties can be very rewarding. If you buy a net lease property at a 7% cap rate, add a little bit of leverage on it, you can get to 10% cash on cash returns, then you add a bit of growth to it, and you get to 12 to 15% annual total returns. That's precisely what the biggest net lease REIT in the world, Realty Income, has achieved historically. It has managed to compound investors' capital at roughly 15% per year. So the risk to reward is very attractive here. In a sense, the risk profile of a net lease property is closer to a bond, but its returns are much closer to that of an equity investment. Today, there are many REITs that specialize in this property sector, but which one are the best to buy today? Hey everyone, this is Vici. I run an investment firm that specializes in REIT investing, and in today's video I'm gonna talk about two of my favorite net lease REITs. Vici Properties, ticker symbol VICI, and EPR Properties, ticker symbol EPR. I'm going to present both of these REITs, I'm going to compare them to each another, and finally make sure to stick till the end because I'm also going to let you know which one is my favorite today. And finally, before I get into it, if you could please like this video, it will help me a lot to grow this channel. I'm putting a lot of work to try to provide you guys as much content on REIT investing as possible, and sometimes a bit discouraging to not get many views, but if you could like this video, it will help me a lot, so thank you so much. So back to Vici and EPR. These are both net lease REITs that specialize in experiential properties such as casinos, water parks, golf complexes, ski areas, amusement parks, movie theaters, and other things. They specialize in these specific segments of the net lease market because they're a lot less competitive, there are fewer buyers, and so they have greater bargaining power with sellers, tenants, and it allows them to structure even more rewarding investments with higher cap rates, longer lease terms, less management responsibilities, and higher rent escalations. Historically, both REITs have greatly outperformed the market. I'll put first on the screen the track record of EPR, and now finally I'll also put the track record of Vici. You can clearly see that both of these REITs have performed really well in the past, and I think that this strong performance is going to continue in the future. But which of these REITs is today the most opportunistic? Well, unfortunately, this question is not simple to answer because it really depends on what you're looking for. I think that both REITs are very attractive for different investors. EPR is probably going to be the best pick if you're looking to maximize your total returns and you're willing to take a bit more risk with higher volatility. Vici, on the other hand, is going to be more attractive for investors who have a lower risk tolerance and want to outperform with limited risk. But ultimately, I think that the best risk to reward is achieved here by combining both REITs together in a well-diversified portfolio, and that's exactly what we are doing at High Yield Landlord, which is my REIT newsletter. I'll put a link in the description for a 2-week free trial if you want to access our full portfolio. So what are the pros and cons of each REIT? Let's start with Vici Properties and its pros. There are really 3 of them. So the first advantage of Vici is that it owns very resilient properties. Most of its assets are trophy casinos such as the Caesars Palace in Las Vegas or the Venetian. These are properties that enjoy huge barriers to entry. There's a lot of demand for them, limited supply, the tenant is highly dependent on your property, the location is exceptional, the building quality is very good. There's also a casino license that's tied to this specific property, and finally, the building itself has a brand value. Therefore, we can objectively say that these properties are more resilient than most other net lease properties. I mean, this is among the most resilient real estate altogether. This also explains why Vici's tenants paid their rent in full and on time even during the pandemic when its tenants weren't even able to operate their businesses. Then the second advantage of Vici is that it has rapid growth prospects. Historically, it has managed to grow its dividend and its FFO per share at a high single-digit growth rate, and again this year it has guided to grow its FFO per share by roughly 10%. It's able to grow so fast because it has access to low-cost capital, it's buying high cap rate properties, earning good spreads in the process, and at the same time, its properties are also growing their rent at a rapid pace. And then finally, the third advantage of Vici properties is that it has CPI adjustments in its leases. Most net lease properties only have 1 to 2% rent escalations each year. These are fixed rent hikes, and the issue of these during times of high inflation is that your rents don't really keep up with inflation. But Vici has some CPI adjustments in its leases to protect it from this. Most of its CPI adjustments are limited, they are capped to roughly 3% per year, but anyways, it provides some additional properties that most of the net lease investors don't have. Now on to the cons of Vici. Number one, its valuation is not quite as opportunistic as that of EPR. Today it's priced at 15 times FFO. That's not expensive, but it's not particularly cheap either. Vici was one of the best performing REITs over the past year, and as a result, it's comparatively a bit more expensive than most REITs and more expensive than EPR today. Then the second con, it's getting really big. Today its market cap is around 30 billion, and the consequence of this is that it could get harder for Vici to grow in the long run because each new acquisition will have a smaller impact on the bottom line of the REIT. Finally, the third disadvantage of Vici is that it's not very diversified. Its investments are big ticket items, and so it owns only 50 properties today. About half of its revenue comes from the Las Vegas Strip itself, and so you're highly concentrated on this one single city. If it's performing well, this is great obviously, but if Las Vegas is someday going to go through some difficulties, this could very negatively impact the market sentiment of Vici. It also generates most of its cash flow from two tenants, Caesars and MGM. Both are doing well today, but again, you don't have really good diversification here compared to most of the net lease REITs. Okay, so that was Vici. Now let's switch to EPR properties. What are its advantages over Vici? Well, the first one is obvious, it's its valuation. EPR is today priced at just 8 times its FFO, so its valuation multiple is nearly 2 times lower than that of Vici. Its dividend yield is also nearly 2 times higher at 9% compared to near 5% for Vici. This lower valuation is at least partly justified because EPR has slower growth prospects. It also owns riskier properties. I'll discuss this a bit later, but I think that the differential here in valuations is excessive. If Vici trades at 15 times, perhaps EPR should trade at 12 times. It should trade at a discount, but the discount really is excessive, and because of this, I think that EPR is quite opportunistic right now. The second catalyst here is that EPR has a stronger catalyst than Vici, in my opinion, in today's market. What is this catalyst? Well, EPR generates about 40% of its revenue from high-quality movie theaters. Today, the other 60% of its portfolio is performing really well. These are water parks, amusement parks. These assets enjoy 3 times rent coverage. The rent coverage is even higher than before the pandemic. These properties are performing exceptionally well because in the post-pandemic world, people are seeking experiences, and so they are spending a lot on this type of properties. But unfortunately, its movie theaters are today still struggling. The box office has not yet recovered, and so the rent coverage is today only 1.4 times, which is lower than before the pandemic. This is concerning the market, but fortunately, I think that things are going to improve here. Most major studios like Paramount, Disney, Warner Bros. Have now realized that their digital strategies aren't working. When you put a movie online, it gets pirated. Even if someone buys the movie, then their friends and family watches it for free. And so it's very hard to monetize a blockbuster movie with a high production cost online. They've come to the realization that theaters are absolutely needed for this, and so now they're really doubling down on theaters. They're starting to produce more big movies for the theaters. Even Amazon and Apple recently announced that they're going to be spending billions to produce movies for theaters. And so I think that it's very likely that we're going to see the box office recover from here, rent coverage as well, and so this should really help drive the market sentiment of EPR. Then the third advantage of EPR compared to Vici is that it's still very small in size. Today its market cap is around 3 billion, so it's about 10 times lower than that of Vici. I think that this should eventually allow EPR to accelerate its growth prospects once it regains a better market sentiment, a higher valuation multiple, a lower cost of capital. Once the equity market reopens for EPR, and starts issuing equity, buying more properties, we're going to see its growth accelerate from here. And so what are the disadvantages of EPR? Well, we've discussed them already. The properties are riskier. Today, currently, its growth is also slower. But again, you're getting paid for this. You get a much higher dividend yield, a lower valuation, and so not so much growth is needed here. I think that there's a better catalyst, and so we could see very significant upside from here. If EPR's FFO multiple expanded from just 8 to 12, 12 would still be quite conservative, yet that would result in about 50% upside from here. And you earn a 10% dividend yield while you wait. So again, the conclusion here is that there is not a clear winner. It really depends on what you're looking for. I think both are great REIT investment opportunities. Vici is a great GARP, so growth at a reasonable price type investment. Vici is a great value pick today with significant upside potential and a high dividend yield that I think will be sustained in the future. So it really depends on your risk profile, your return objectives. Personally, I'm investing in both of them because I think that ultimately you achieve the best risk reward by combining both REITs together. This allows you to earn a roughly 7% dividend yield. You still have fast growth thanks to the casino component of Vici, and then thanks to EPR you get to diversify a bit better the overall portfolio, so you're not so heavily exposed to just these two casino tenants. Now, if you want to learn more about Vici, make sure to watch my recent interview with the CEO of the company. I met him at the City Global Property Conference, and we talked for about 10 minutes about their future growth prospects, their current valuation, and how he expects the company to perform in the future. Finally, a quick reminder here, if you want to access my entire portfolio, you can do so for free by taking the 2-week free trial to my REIT newsletter, High Yield Landlord. I'll put a link to it in the description of this video. And again, if you could like this video, it will help me a lot, as I said earlier. Thank you very much for watching. See you at my next one. Bye-bye.